In the high-octane world of semiconductor investing, Nvidia remains the undisputed king, powering everything from AI breakthroughs to gaming revolutions. With Nvidia's stock surging over 43.92% year-to-date as of early November 2025, income-focused investors have flocked to a niche corner of the ETF market, Nvidia-themed income funds. These vehicles promise monthly or weekly distributions, often via option strategies, while offering capped exposure to the chip giant's upside in some cases. But a closer look at the data reveals a stark irony. The funds drawing the biggest crowds are delivering the weakest total returns, leaving savvy investors wondering if they're betting on the wrong horse. Four prominent Nvidia income ETFs dominate this space: the YieldMax Nvidia Option Income Strategy ETF, the Roundhill Nvidia Weekly Pay ETF, the Granite Shares Yield Boost Nvidia ETF, and the Rex Nvidia Growth and Income ETF, launched or ramped up in 2024 and 2025 amid Nvidia's AI-fueled rally. These funds use covered calls, leveraged bets, or derivative overlays to generate yields often exceeding 50 to 100% annually. Yet, as total return data from June 1st to November 6, 2025 shows, performance has been anything but equal. When you step back and look at total return, not just distribution yield, but the full picture, price appreciation, distributions, and reinvested dividends, the story becomes a lot clearer. Over the 5-month period ending November 6, 2025, here's how the Nvidia-themed income ETFs actually performed. NVII is up 45.16%. NVDW is following closely, up 42.01%. NVDY is up 31.56%, but lagging the previous two by about 10%. And NVYY is up 31.29%. And right away, one fund stands out: the Rex Nvidia Growth and Income ETF, NVII. It's the undisputed leader of the pack, managing to combine high-yield income with genuine upside potential. Its strategy struck the right balance, capturing cash flow and participating in Nvidia's rally. During a volatile summer, when headlines about US and China trade tensions and the Fed delaying rate cuts sent the market swinging, NVII handled that turbulence with impressive stability, steadily grinding higher and, at times, even outperforming Nvidia itself. Right behind it, NVDW also showed solid execution. The laggards, NVDY and NVYY. Despite their big yields and aggressive marketing around income potential, both struggled to keep up. NVDY's strategy drag was a clear anchor. Those capped gains during Nvidia's massive summer breakout left investors watching the stock soar while their fund barely moved. And NVYY's leveraged structure? That worked great in calm, trending markets, but in the choppy trading we saw in August, those daily resets amplified losses and erased a lot of the momentum it had built earlier in the year. So, when you line them all up, the takeaway is simple. The smarter funds this year weren't the loudest ones promising the highest yield. They were the ones that balanced income with adaptability. Here's where the story gets frustrating, especially for retail investors. When you look at the assets under management, it tells a completely different story, one that's more about herd mentality than actual due diligence. As of November 10th, 2025, here's how investors have allocated their money to these Nvidia-linked ETFs. NVDY has $1.69 billion of the assets under management. That's roughly 80% of the total amount investors have put into all four funds. NVDW has about $131 million in assets under management, or 6%. NVYY, roughly $110 million, about 5%. And NVII, the best performer on a total return basis, just $53 million, or 3% of the total. And that's the part that doesn't make sense. NVDY, the second worst performer of the bunch, by a tiny percent, has the most money flowing into it because of hype. It's classic yield chasing. From mid-year to now, NVDY ballooned from under $500 million to over $1.6 billion. Despite all that attention, its total return is sitting around 36%, lagging the top performers by 15 percentage points or more. That's about $250 million in missed gains for investors just this year. Meanwhile, NVII, the best performer, sits quietly at the bottom in terms of size. Behavioral finance explains this perfectly. Investors don't chase results, they chase stories. The headline says 90% yield, and that's all most people need to hear. The problem is, Distribution yield doesn't equal profit, and monthly distributions don't mean you're actually growing wealth. Or, as one ETF analyst recently put it on Bloomberg, it's the shiny object syndrome. The biggest funds get the love until the charts tell the truth. And right now, those charts are crystal clear. For the 2025 investor looking for Nvidia exposure with a little income on the side, the data is sending one loud message: look at total returns, not just distribution yield. NVII's performance this year has been great. It captured upside, paid strong income, and managed volatility better than most of its peers. But let's be clear, no fund is bulletproof. We saw that in early August, when Nvidia dropped nearly 20% in just a few weeks. Nvidia's story this year has been great, and what's happening with these ETFs really highlights how investors chase the idea of income, sometimes at the expense of total return. The thing I keep coming back to is that yield is only part of the picture. What really matters is what's left after everything: distributions, price moves, and compounding over time. When you look closely, the funds that stay flexible and manage their strategies intelligently tend to quietly outperform the ones that just sell the highest yields. That's something to keep in mind if you're building income for the long term. Let me know what you think about these Nvidia ETFs in the comments. Are you holding any of them? Or do you prefer just owning Nvidia directly? I'm really curious how investors are positioning around this kind of strategy. And if you found this breakdown useful, don't forget to like the video, subscribe, and turn on notifications. I've got more ETF and dividend portfolio breakdowns coming soon. Thanks for watching, and see you in the next one.